Hey guys, my name is Dom Rinaldi and welcome to Dom's Deep Dives, a YouTube channel that's part of the Pounding the Table podcast network, where we're dedicated to helping you learn how to invest in stocks and beat the market. Now, if you enjoy this content, the only ask we have is to smash that like button and help us deliver more new content like this to you. And hit subscribe so you don't miss any of the other episodes of our YouTube channel. Now, are you ready to dive into the deep water? I know I am. Let's go. Welcome back to Dom's Deep Dives. I'm Dom Rinaldi, and you're watching one of the shows on our Pounding the Table network. Today, we're going to take a break from our NVIDIA Deep Dive. I realized I threw you guys in the deep part of the ocean without giving you the proper flippers and goggles and gear to swim. We're going back to the basics to help new investors learn how to pick out great companies and where to even start. So let's dive in. So what is a stock? A stock are shares of a company that represent ownership equity in the firm, which gives shareholders voting rights as well as residual claim on corporate earnings in the form of capital gains or dividends. We'll dive further into this in a little bit. Stock markets are where the individual and institutional investors come together to buy and sell shares in a public venue. Nowadays, these exchanges exist as electronic marketplaces. Did you know that the stock market is actually as old as the 1600s? It's older than our US Constitution. People were buying shares of stocks of shipping companies and having part ownership in those organizations. Now, share prices are set by supply and demand in the market as buyers and sellers place orders, and order flow and bid-ask spreads are often maintained by specialists or market makers to ensure an orderly and fair market. So there's a seller on the other end of that transaction, and then there's a buyer. And they're trying to negotiate on what is a fair price that they want to sell that share of stock to or buy that purchase of stock in that company. So what is the power of investing over time? And we'll get into actually how to invest, set up a brokerage accounts in other episodes, but I want to talk about the advantages you have as a retail investor over hedge funds. The beauty of investing is that you could be a non-expert in this profession and still beat the professionals. What other industry do you know that you can do that? You can't join the NBA just because you want to play and beat LeBron James in a one-on-one game. But in investing, you can. Now we'll talk about some of the key things that retail investors have at their competitive advantage. The biggest one is time. Now, compounding is key. Now, don't feel just because you may be older in age that you can't start now, because that's so false. Joey invests $200 per month starting at age 45. He contributes a total of $48,000. And you can see that Jill's investment tripled in just 30 years. And then Jack invests at age 25 that $200 per month, and he contributes a total of $96,000. But it's almost $600,000 by the time he reaches that same age of 65. So there is advantages of starting early, and we always encourage our children to start early. Teach your kids about the power of money and money working for money and investing in stocks. Now, what goals do you have for the money that you are investing in? Is it retirement? Is it a new house? Passive income when you retire? Generational wealth? Maybe you want to leave a legacy for your family for years to come so they don't have to pay for college. Or the FIRE movement, financially independent, retire early. Now, I'm more on the financial independent side of the house because I don't consider retirement as playing golf on the courses all day, but instead talking to you about investing and helping others learn how to beat the market. And that's what gives me joy in helping others learn that they too can beat the stock market. Now, you may want to save for your kid's college fund or wedding, or even travel all across the world with multiple vacations. You know yourself better than anyone else, and why do you invest? There is this fundamental truth that investing in stocks is the best way to compound your money. Now, with these foundational truths, we're going to go over a couple of them to make sure that we're preparing you before you jump into the deep end and open up your brokerage account and start investing. Now, are you ready, like Jack said? Are you ready to handle the truth? Let's go. Okay, so now I'm going to disappear here for a second because we have some text that I don't want you to miss. Be aware of your emotions. Stocks go down faster than they go up. It's like a roller coaster, but they do go up more than they go down. And this is a great quote from one of the greatest investors of our time, David Gartner, co-founder of The Motley Fool. Now, our second point is know thyself. If you are investing for decades to come, why do you care about a 20% drop in a day? As long as the thesis is intact and you are not using money that is needed within the next 3 years and you're financially secure, you might want to look and see if everything's good to go on the company. Maybe this is a good time to add to your position. Now, once again, this is not financial advice. I'm not telling you to buy stocks, sell stocks, but just giving you entertainment and educational information on how I invest in the market. Don't check your brokerage account every day. The dopamine effect can be great when things are good, but it can also be disastrous when things are bad. It'll cause you to make bad decisions, selling too early or overreacting. And don't listen to the media, whether you're watching the news and what they're telling you or what to buy and what to sell. Someone is always selling you. Trust yourself. And this is where it's so key. Here at Pounding the Table Network, we talk about doing your own due diligence. You can't earn the right to pound the table without doing your own homework, researching the company, watching CEO interviews, and learning about the company you're investing in, so this way you have high conviction and can hold through the drops. Do the opposite of what these people are doing. They do sell when it drops too much in a day. They do freak out and panic. Don't check the markets every day. Instead, look at the thesis if it's intact and consider buying more. Or maybe there's another opportunity for a smaller company that has more growth run rate and you want to actually use that money to sell on a larger cap company and put it towards a faster growing stock. Now, choose to invest in areas of expertise or interest that you're passionate about for a competitive advantage against the market. I have experience in SaaS software and technology sales for over 20 years. So this is my area of expertise where I spend most of my time investing. But I also really like to learn about genomics and healthcare and where our healthcare system is going, because I really want to make sure I'm investing in a better future than what we have today. But if you're familiar with retail or advertising or consumer goods or entertainment, whatever drives your interest or you have expertise in will give you an advantage over other professional analysts or investors. Now, I know we talked about time and patience is your biggest advantage as a retail investor over hedge funds and analysts, but this graph depicts it. The growth of $10,000 since 1950 and what that amounts to by trying to time the market is crazy. Now, this is just my opinion. I have actually other team members who think differently about investing and possibly trying to time the market. So what I'm saying here for me personally is that missing the best 25 days provided only a 5% annualized return on that $10,000 over all of that time since 1950. Missing the best 15 days gave you a 5.8% annualized return. And missing the best 10 days gave you a 6.2%. But if you just left it and held it, you had a 7-point annualized return compounding over all that time since 1950. So instead of $321,000, you would actually have $1.56 million. I really like that number a lot better. Now guys, I know this is exciting and it's fun stuff, but don't rush in. Learn the market terminology. What is a market cap? A lot of people think that you care about the share price and don't understand that market cap is actually how you evaluate how large a business is. That's the share price times the total number of shares that a company has outstanding. So if a company has $1,000 share price, but they only have 10 shares, then it's a pretty small market cap. Price to sales, price to earnings, limit or market order, insider ownership. Is the CEO invested in his own company? Does he own shares? Is he aligned to shareholders? You can also start with paper trading. This allows you to try to learn the market without the consequences. There's no money involved. You can just pick your stocks through a brokerage and figure out what is working for you and how you want to invest. Or dollar cost average. You don't have to buy in lump sums. And I struggle with this all the time because I want to buy in when I see a big dip. But then it dips even more the next couple days. So you have to have discipline and patience when you're investing. And stock dilution or stock-based compensation. These are complex ideas because they can be good for a company depending on what their situation is, and they can be bad. Now, profit margins is also very important, but sometimes a company wants to reinvest in the company when they're early starting and not take profits, and that's okay. So there's a lot of things you can start learning from. I encourage you to go out there and learn the terminology before just putting money out in the market. Don't pay attention to the day-to-day movements. We've already talked about this, but continue to check your thesis. In order to check a thesis, you have to have a thesis. Going back to doing your own due diligence, doing your own research, and finding out why would you invest in this company? What intrigues you? What are they doing from a fundamental standpoint? And are you keeping up with it? And if they are dropping for a particular reason, but they're still moving forward and that thesis is intact, then it could be an opportunity to buy. What I like to show in this chart is that we have always had crazy times in our world, whether it was the Black Monday drop, or whether it was the housing crash in 2008, 2009, or whether it was recently COVID. We are a resilient stock market, and you can see here, it always goes up and to the right if you hold through time. Now, understanding the market cycle and if it matters to you depends on what kind of investor you are. If you're a day trader or swing trader, the sector rotations and the cycles that the market moves in are important to you because you could get hurt really bad if you're in a technology or growth stock in the wrong time. Now, if you're a long-term investor, that really doesn't matter because over time, what does it do? It goes up and to the right. And if you're an invader like me, you do care a little bit because there will be chances that you have things on sale because technology is undervalued at that moment. And that's when I want to buy more of what I care about in technology stocks. Now, how to start investing. There's so many different options out there. There's Fidelity, there's E-Trade, there's Ameritrade, Merrill Lynch, Interactive Brokers, Robinhood, Webull. Where do you begin? We'll talk about this. There's different advantages in certain brokerage accounts. What I would say is you want to make sure you have a brokerage account you feel comfortable with, that you know is FDIC insured, and also allows fractional shares so that way you can buy larger stocks like Tesla or Amazon and invest in things that you truly are passionate about regardless of the share price. Hopefully this deep dive on how to invest in stocks and how to find winning companies was helpful to get started. We'll focus more in our next part around how to find winning companies and really looking at balance sheets and growth sectors and looking at a top-down approach in investing or a bottoms-up. And what does that mean? So thank you again for watching, and we'll talk soon. Thank you guys for watching. Hopefully you enjoyed this content and learned something new about investing. Now, if you did like it, make sure to smash that like button. Help us deliver new content for you. And hit subscribe so this way you don't miss any other episodes of our YouTube channel. You can also listen to our network podcast, Pounding the Table, so you can learn more about stocks and learning how to beat the market. Now, are you ready to jump back in the water and dive in? I know I am. So until next time.